Part 2. I'm winning, what should I do? In Part 1, I introduced you to 3 different investing tribes: the rabbits, the assassins, and the hunters, and demonstrated how good execution of a losing idea can not only salvage a losing position but turn it into a winning one. In Part 2, we will meet 2 further gangs of investors, the raiders and the connoisseurs. Through them I will endeavor to show you what you should and should not do if you find yourself in the fortunate position of holding a winning stock. You might think that being in a winning position makes things a lot easier. But it pains me the number of times I have seen professional investors destroy wealth by doing the wrong thing when they are winning. Many are anti-alchemists, turning gold into lead. Worse still, they get paid a lot of money for doing it. As in Part 1, the villains and heroes you meet on the following pages are a number of real, very famous investors, and all the trades you see are real. 2. Chapter 4. The Raiders, Snatching at Treasure. Raiders occupy a thin line between success and disaster. These are investors who like nothing better than taking a profit as soon as practical. They are the stock market equivalent of Golden Age adventurers, having penetrated through the dense jungle, found the lost temple or buried treasure. They fill their pockets with all the ancient coins and gems they can then turn tail and run. Unlike Golden Age adventurers, they are rarely chased by angry locals or rivals. The only boulders rolling after them are in their imaginations. They are terrified of getting caught and losing everything, and to ensure they at least come away with something end up leaving countless chests and bags of treasure behind completely unnecessarily. It's a sad case of what you might call premature evacuation. I was lucky to have some successful raiders investing for me who more often than not did find treasure, so it added up to profit in the end, even if it wasn't as much as I would have liked. But it would only have taken getting caught in 1 or 2 well-primed temple traps to end their adventures for good. And not all of the raiders were so lucky, even one with an incredible record of good calls came a cropper in the end. This chapter, therefore, is cautionary. When winning, you do not want to do what the raiders did: investing on the edge of ruin. I discovered the raiders when I noticed the rather distressing fact that one of my investors had an incredible success rate. Almost 70% of his ideas were correct, which is truly phenomenal, but he hadn't made me any money. I broke down the data for his investments and discovered that whenever he made a small gain, say 10%, he would immediately sell the stock and take the profit. Interestingly, he was a hedge fund manager and in his own trading was an expert at shorting shares and staying short. But when it came to long-only investments, he and the other raiders lacked a key habit that the successful investors I worked with possessed. He did not embrace the right tail of the distribution curve. In ordinary terms, the raiders did not run their winners. Let's look at some unhappy examples of this in action. Case study: Chicago Bridge and Iron. Chicago Bridge and Iron, or CBI, is a large multinational company that likes to think of itself as a one-stop shop for energy industry infrastructure projects. One of the raiders bought into CBI on September 3, 2009 when the shares were trading at the sterling equivalent of £10.66. 1 month later, on October 5, 2009, he sold with the stock trading at £12.29 per share. I spoke to the investor about this and it was clear he felt very pleased with himself, bagging a tidy profit of 15% in just 1 month. But, as I write, the stock is trading at the sterling equivalent of £30.38 per share. In other words, the stock went up another 147% post-sale. The investor in question did not reinvest the proceeds of his sale into another idea that produced anything near as high a return as this. Assuming an annual average return for the stock market of 8% per annum, this raider voluntarily gave up 12 years' worth of returns by bagging his profits too early. Case study: British American Tobacco. British American Tobacco, as the name implies, manufactures and sells tobacco products. While you may not have heard of the firm itself, you may be familiar with some of its famous cigarette brands. These include Lucky Strike, which is particularly popular in the USA, and Pall Mall, the third biggest cigarette brand in the world. Other brands include Vogue, John Player, Benson & Hedges in Kent. One of the raiders I managed took the view that the cigarette giant had seen the bottom in its share price on July 3, 2009, so he bought the stock when it was trading at £19.96 per share. 2.5 months later, on September 21, 2009, he sold at £21.75 per share, making a profit of 9%. I don't mind telling you that when I met this investor, he was very smug, having bottom-picked the market. Unfortunately, I was less than amused. I thought I had hired an investor, not a trader. After he sold the stock, it continued to go up. At the time of writing it, trades at £37.93 per share, a further 74%. Assuming an annual average return for the stock market of 8% per annum, this raider voluntarily gave up 7 years' worth of returns. Case study: Swedish Match. Sticking with the tobacco theme, one of the raiders I managed also invested in Swedish Match. This company is a world leader in chewable tobacco, not matches. This investor bought into the stock on October 10, 2008, when the shares were trading at the equivalent of €10.56 per share. This investor stayed invested for just 2 months, selling at the equivalent of €10.18 per share on December 16, 2008, at the height of the global financial crisis, thus suffering a small loss of 4%. He then decided to buy back into the stock on June 24, 2009 at €11.23 per share, before selling out of the stock again on April 22, 2010, with the stock trading at €17.54 per share. Second time around, he made a profit of 56%. I imagine many of you are thinking, what is wrong with that? Well, had he stayed invested, he would have made 145% at the time of writing. The stock is trading at the equivalent of €25.88 per share, a further increase of 49% since he sold the second time around. Case study: Novo Nordisk. Novo Nordisk is a Danish pharmaceutical company that is the world leader in diabetes medications, insulin, and care equipment, injection devices and needles. It also has a leading position with respect to hemophilia care and hormone replacement therapy. One of the investors I managed chose to invest in Novo after the stock had been doing nothing much for a while. He initiated a position on 22 April 2009 at the equivalent of €35.71. He later sold the stock on 4 December 2009 when it was trading at €45.32 per share, making a decent profit of 27%. I can picture him running around his office giving his co-workers big high fives. Unfortunately, after he sold, the stock continued to go up. As I write, it is trading at €124.92 per share, a further increase of 175%. Assuming an annual average return for the stock market of 8% per annum, this investor voluntarily gave up 13 years' worth of returns. Time and time again, my analysis showed that had the raiders stayed invested in their winning ideas, they would have gone on to make a lot more money. Furthermore, because of this failure to run their winners, a few large losses in due course wiped out most of the raiders' small gains. The raiders were a good example of investors that are right most of the time and still lose money. They have high hit success rates but poor payoff profiles. Data point: The danger of cutting your winners. Reviewing all the trades that my investors made, I wanted to see on average how detrimental it was for a manager to take a profit when the stock was up by 20% or less. In total, 611 stocks, 66% of all winning investments, were sold for a profit of less than 20%. Of these, 370, or 61%, kept going up, and had the investor stuck with them, he or she would have made even more money. While the magnitude of subsequent outperformance differed, the fact is that big winners were to be found amongst those 370 names. Moreover, the most successful investors I worked with, those that made the most money, all had one thing in common: the presence of a couple of big winners in their portfolios. Any approach that does not embrace the possibility of winning big is doomed. I think we can all relate to the Raiders' desire to take profits on winning investments. The problem is that taking small profits is like picking up pennies in front of an oncoming train. It only works until the train comes along. Why do investors sell too soon? There are a number of key reasons that these investors became raiders. Looking back on my time with them, the following stand out as reasons that they repeatedly sold too soon. 1. It feels so good. Selling for a profit is a nice feeling. When we win, testosterone and dopamine are produced, and these hormones make us feel good. So damn good that we want to do it again, and again and again. As any smoker will tell you, it is hard to stop doing something that gives you pleasure. The raiders were effectively drug addicts. They weren't constantly snorting lines of cocaine with rolled up snippets of the FT, but they had become addicted to the chemicals their bodies would release whenever they took a profit. 2. I'm bored. Reflecting on selling his investment in Warner Brothers, legendary investor Peter Lynch admitted, "I got bored. Getting tired of waiting for action is part of human nature." Lynch summarized the problem well: it's normally harder to stick with a winning stock than it is to believe in it after the price goes down. 3. Frustration. Nothing is truer than the saying, "Feel the pain of the gain" when it comes to staying invested in a winning position. Staying invested in a winning position is like taking the kids on a day out to the zoo, but you have a 2-hour car drive before you get there. Halfway through the journey they start asking, "Are we nearly there yet?" in ever louder voices. 3/4 of the way there, they begin kicking the seats. The only way to get to the zoo and ultimately enjoy your day is to put up with the pressure and not give in. Self-control issues. These first 3 issues tend to go together. We have self-control problems when faced with a decision today that is very pleasurable, like taking profits. We find it very hard to say no. Various studies have shown that humans prefer $1 today versus $2 tomorrow, a phenomenon that has been termed hyperbolic discounting. Raiders are present biased without realizing it. In the morning, when temptation is remote, we vow to go to bed early, stick to our diet, and not to have too much to drink. That night we stay out until 3 a.m., have 2 helpings of chocolate decadence, and a variety of aquavit at a Norwegian restaurant. 4. Fear. The research of Shlomo Bonartzi and Richard Thaler also showed that the pain of a short-term loss overpowers the pleasure of a long-term gain. This myopic, short-term, focus and a hatred of losing they called myopic loss aversion. This produces a fear which turns many investors into raiders when a share starts doing well. The findings of Terence O'Dean suggest that this problem has grown thanks to the unprecedented immediacy of the internet. He discovered that people who traded via telephone from 1991 to 1996 outperformed the market by 2.4% per year on average. However, when they changed to trading online, they underperformed the market by 3.5% per year. 39. Incidentally, Odin also found that stocks investors switch into after selling. Winners tend to underperform the old ones by 2.3%. 40 investors think they are getting rid of weak winners and replacing them with stronger ones, but in fact they are usually doing the opposite. 5. Short-termism. Many an investor becomes a rater because of a natural disposition to focus on the short term. The technical term for this is recency bias. My own fund, the Old Mutual European Best Ideas Fund, is a good example of this in action. If you took a 3-year view from 2009 to 2011, you would have said I was a superstar. If you viewed my performance during August 2011, or for the year 2011 alone, you would have said quite the reverse. The flows my fund experienced showed just this. Shortly after delivering those 3-year performance figures, I had over $200 million invested into my fund. But during August 2011, clients withdrew tens of millions of dollars. Since 2011, the performance of the fund has been strong and, surprise, we have attracted inflows again. Imposing different time frames on an investment can produce very different results, and raters invariably impose short-term ones. This can be deadly for winning trades. Many investors seem to have a dangerous habit of buying high, a prior big winner, and selling after a small gain. They like to strike while the iron is hot. 6. Risk aversion. In 1979, Tversky and Kahneman published another groundbreaking paper introducing what they called prospect theory. The paper dealt with how people make choices in the face of uncertainty and risk. Kahneman and Tversky found that whether a person is winning or losing affects how they make a decision. People are risk-averse when winning, hence they take profits, but risk-seeking when losing. It seems the driver behind this human habit to take profits early is related to the certainty of the outcome an individual is facing, and whether that outcome is desirable. When losing, risk is appealing because anything is better than a certain loss. When winning, selling is appealing because the certainty of a small victory is better than the uncertainty of a loss or greater victory. The secrets of the boxes. Many readers will be familiar with the TV show Deal or No Deal. The concept is very simple. There are 26 boxes, and hidden in each is a cash prize between 1 pence and £1 million. One by one, the contestant has to discard a box and forfeit whatever prize money is inside it. At various points in the game, the contestant will be offered a cash prize by a banker to walk away and thus forfeit whatever prizes are left in the remaining boxes. The bigger the potential prize left in the remaining boxes, the keener the banker is to try to get the contestant to accept the alternative cash prize. Thus, you could have 2 boxes left, one with £1 million inside and the other with £50,000. The banker might offer you £150,000 to walk away. Many people do take the certain £150,000 instead of risking walking away with just £50,000. It's emotionally very hard to risk losing a certain profit for a potentially bigger, but uncertain, profit, and most cannot do it. The behavioral economics experts Dan Ariely and Ziv Karman undertook a fascinating study of Deal or No Deal, which every investor who feels the temptation to be a rater should read. We have an irrational tendency to be less willing to gamble with profits than with losses. This means selling quickly when we earn profits but not selling if we are running losses. Said by Lars Tvede. Why you shouldn't sell early. If the example investments earlier weren't enough to persuade you of the folly of being a stock market rater, here are 5 big reasons that it makes no sense. 1. Rarity value. Big winners are rare, and I am yet to see a successful investor who has not hung around with big winners. All the successful investors I have managed made money because they won big in a few names, while ensuring the bad ideas did not materially hurt them. Having a process that prevents you winning big because you take profits. Once a stock is up 20 or 30% means that you could potentially be the person who gives away a winning lottery ticket. And not all profits are equal. In the long term, investing in stocks is one of the best ways to make money, but while this is true as a whole, if you are buying individual shares, it very much depends on the stocks you buy. Stock market returns over time show kurtosis, which means fat tails are larger than would be expected from a normal distribution curve. This means that a few big winners and losers distort the overall market return and an investor's return. If you are not invested in those big winners, your returns are drastically reduced. Extremes dominate our world and we think they are the norm. Terry Burnham and Jay Phelan. Rabbits and raiders. Raiders are often rabbits when they're losing, and the combination is fatal. If you combine the urge to sell winners too soon with the reluctance to sell losers, the net result is losing a lot more than you win. You have effectively got an investment style that combines significant downside risk with insignificant upside potential. As Peter Lynch put it, some people automatically sell the winners and hold on to their losers, which is about as sensible as pulling out the flowers and watering the weeds. 2. Beat your rivals. The bad news about being a raider, as we have seen, is that it is so incredibly tempting for most people. But that's also good news. It means that honing the ability to run winners can give you a very easy but significant advantage over your rivals. Data point: premature professionals. Of the 1,866 investments that I analyzed, only 21, or 1% of all investments, returned more than 100%. My findings show that 42% of profit-taking by many of the world's best investors occurred within 3 months of the initial purchase. If you extend the horizon out to 6 months, a staggering 61% of all profit-taking has occurred. Only 2% of profits were realized after a holding period of 3 years or more. These findings corroborate my general observations that behaviorally many find it hard to hold on to winning investments. It is clear that if you can expand your investment horizon, you can have a massive advantage. 3. You cannot trust your next investment. In the introduction to this book, I showed that on average only 49% of top investors' ideas made money. Using these odds, you might be amazed to know that the chances of investing in 5 successive winning trades one after another are far worse than 49%. In fact, statistically speaking, the odds are less than 2%. This should help reinforce the attraction of sticking with a winning investment when you are itching to sell out and take a small profit. It is, however, all too easy to be overconfident about reinvesting those profits, especially if you believe you have nothing to lose. Research by the academics Mike Thaler and Eric Johnson suggests that once a person has sold a winner, his or her behavior turns from being driven by risk avoidance to risk seeking, something they called the house money effect. Investors view their profits as house money, not their own money. If they lose, they feel they haven't really lost anything. Investors need to try to break the link between success and failure in prior investments if they want to succeed. Always remember, selling a winner can seriously damage your wealth. 4. Winners can keep winning. Many studies have shown that momentum investing can be a winning strategy. Stock leadership does seem to persist long enough to exploit it. A greater fool will, almost, always buy at a higher price. Research by Narasimhan Jagadish and Sheridan Titman in 1993 showed that stocks earning relatively high, or low, returns over a 3 to 12 month time frame continued that trend over the subsequent 3 to 12 months. In other words, winning stocks continue to win, they autocorrelate. There are many reasons why winners can keep winning. Some researchers suggest that analysts and investors anchor to old and incorrect earnings estimates for a company and are slow to revise their forecasts higher if they are wrong. As they eventually do revise them, this in turn results in a stock being either re-rated or attracting buyers as it surprises, despite nothing fundamentally having changed. Another possible explanation is a simple bandwagon effect. Investors buy winning stocks because that is what the herd is doing. The longer a winning streak goes on, the narrower and narrower the market gets as all the buyers end up moving into the same winning stocks and sectors. Everyone loves a winner, and a stock whose share price keeps going up and up becomes a market darling. Robert Shiller's findings from research he conducted in 1981 suggest that stock prices are driven more by speculators than by company fundamentals. He showed that stock market prices move well beyond what would be predicted by a rational investment model. Quite simply, stock index returns are too volatile relative to aggregate dividends. Indeed, consider the fact that in December 2006, Alan Greenspan, when he was the chairman of the Federal Reserve, publicly declared that markets were being driven higher due to irrational exuberance. That statement did not stop the stock market going higher for another 3 years before the bubble eventually popped. Of course, caution is still required. Winners may not win forever. Eventually, no marginal buyers are left to bid a stock price higher and a price correction occurs. 5. You can never predict big winners when you first invest. Many legendary investors did not predict their biggest winners, and have admitted it. Some all-time greats even built their investment style around not knowing how big a winner might be. Jesse Livermore became one of the wealthiest men in America in the 20th century by adopting a simple trend-following approach. In effect, he bought stocks that were being bid up and rode them up, never knowing if it would turn out to be a big winner when he initiated the position. Is it ever right to sell a winner? At this point, you may be wondering if it can ever be the right thing to sell a winner. It definitely can be. If you know your reason for investing has been proved wrong, then you have no reason to stay invested. You have been lucky and made a profit, but why should you have any conviction that it should persist? The fact the stock has gone up does not mean you were right any more than a stock going down does not make you wrong per se. Recognize you got lucky and sell. 2. Professional. My findings showed that 68% of the time fund managers took a profit when the stock had relatively outperformed the index by up to 23%. They either had a remarkable natural disposition to avoid big winners, or there were other things going on at the same time. Here are some possible factors, slightly unique to professional investors, though everyone can learn from them. 1. Bonuses. Many fund managers are awarded bonuses based on 1 and 3 year performance relative to a reference index or peer group. When they find themselves in a position of being ahead of that index or peer group, they want to lock in that profit so that they get paid a good bonus at the end of the year. 2. Expectations. Some fund managers I have met will take profits early because they fear the relative outperformance cannot persist. In fact, I have had managers say to me that they have sold out of a stock because they think it will go to sleep for the next 6 months, and as such the capital would be best deployed somewhere else where it can work in the interim. 3. Forecasting. Most fund managers invest with a price target in mind that is only 20–30% higher than their original purchase price. Part of the reason for this is because they only forecast 1 to 2 years out, and only look to be invested in a stock for a short period of time. As a result, many fund managers' processes are not designed to capture big, multi-year winners. 4. Relativity. Finally, many fund managers think in relative terms. A fund manager's performance is assessed relative to an index or his peers. His or her reviewers, employer and clients, are trying to decide whether the manager has been doing a good job. A comparison with an index is suitable because anyone invested in the fund is paying an active fund manager more than it costs to invest in a passive fund, an index fund or exchange-traded fund that simply replicates the benchmark. For that extra fee, the client is expecting the fund manager to materially outperform. A comparison with peers is also fair because the client who has decided that he or she wants to pay for active management could have invested with a number of other active managers. Many studies over the years have shown that clients have a bias to investing in the best performing funds. Typically, they are funds that are first quartile, ranked in the top 25% of all funds in that space. So being assessed on a relative basis leads fund managers to pay a lot of attention to how they are performing relative to both the benchmark index and their peer group. Worse still, some do this on a daily basis. They know the value of their holdings almost to the hour, and it leads to a lot of unnecessary early selling. It helps professional investors think that stocks are riskier than they actually are. By monitoring a stock they are invested in several times a day, they notice the share price moves up and down quite a bit. The price seems volatile. But what if you just reviewed an investment every 10 years? You would probably find that the stock has made you quite a lot of money. Moreover, because you did not check the stock price during that 10-year period, you did not notice the price moving up and down every day. You never experienced the pain of a 20% fall in one day, perhaps 50% in a year. You were completely unaware of the volatility of the ride you were on. You therefore come to the conclusion that investing in the stock market is not risky at all. Why was one Raider such a successful hedge fund manager? Having read this far, you might be wondering how the Raider I mentioned at the beginning was such a lousy long-only investor for me but so successful in his day job shorting stocks at a hedge fund. Funnily enough, the two things go hand in hand. When you short a stock, you are looking for the exact opposite in an investment, so this Raider's destructive investment style turned out to be perfectly suited to shorting. The ruinous policy of cutting his winners and running his losers in investing was the rigorous and prudent policy of running winners and cutting losses when applied to shorting. When shorting, he sold when a stock rose 10% so as to keep the losses small. When a stock fell in price, he wrote it down, thus running his winners. In both cases, he was getting rid of rising stocks and sticking around with losing ones. I also believe that a key reason it was easier for him to stick with a winning short was that, as it got more profitable, his weight in that stock reduced. The net result being less and less capital was at risk as the short worked. It's clear that what affected him most profoundly is upside and downside risk. In shorting, the upside is capped at 100%, a stock cannot fall lower than zero, but the downside is potentially infinite, a stock can keep on rising and rising. In investing, the downside is capped at 100%, but the upside is potentially infinite. The former scenario encouraged him to be ruthless with losses and greedy with winners. The latter encouraged him to be indulgent with losses and impatient with winners. It is obviously worth thinking about how these factors affect you and tailoring your investment approach accordingly. It could be the difference between legendary success and limp failure. Resisting the raid. In psychology circles, there is a famous test in which a marshmallow is placed in front of a young child. The child is told that if he doesn't eat the marshmallow. In the next 30 minutes, he will be rewarded with an additional marshmallow. The researcher then leaves the child alone in a room with the marshmallow sitting in front of him or her on a plate. There are no distractions, no TV, no music. It is just a room with a kid sitting at a table looking at a marshmallow. As you might imagine, after just a few minutes, most children tend to get fidgety. And in most cases, the child succumbs to temptation and shortly thereafter wolfs the marshmallow. Let's face it, half an hour in a room with no toys must feel like 30 years to someone that age. The point of this test is that it demonstrates a phenomenon known as temporal choice. If something is offering us immediate pleasure, like taking profits, we struggle to see the pain it will cause us in the future. We become nearsighted, myopic, and sacrifice potentially large long-term gains for small short-term ones. Raiders cannot help but eat the whole marshmallow. On the other hand, the final and most successful tribe of investors, the connoisseurs, have a solution to the marshmallow problem. End of the chapter 4. The Raiders, snatching at treasure.